if a company just had its first profitable quarter and secured $750 million in new contracts,
Right.
why are the people running it selling tens of millions of shares?
Well, you are looking at the ultimate market contradiction right there.
Yep.
I mean, on one side, there is this glossy, highly publicized narrative of massive growth.
Yeah.
But on the other, the people who actually see the bank accounts are quietly heading for the exits.
Yeah, and we're getting into all of that today. We're taking a deep dive into Datavault AI Inc. You'll see it trading under the ticker DVLT.
Right.
And this is honestly one of the most polarizing, highly debated stocks out there right now. Like, if you pull up the ticker DVLT right now, today is April 15th, 2026, you are looking at a stock sitting around 70 cents.
Yep, 0.7001 to be exact.
Exactly. And that is a massive, painful drop from its 52-week high of $4.10.
Yeah.
But confusingly, it just spiked nearly 25% in the last couple of weeks.
Which creates an incredibly volatile psychological environment for, anyone watching the market.
Oh, absolutely.
I mean, long-term holders are feeling the pain of an 80% drop, while short-term momentum traders are jumping in, trying to basically catch a falling knife just because it suddenly bounced.
Right. So our mission for this deep dive is to unpack the mountain of financial data, the technical signals on the charts, and this wild insider activity to help you determine what is actually going on here.
Yeah, we really need to figure out if DVLT is a wildly undervalued opportunity right now, or if it's just, a classic retail value trap.
Definitely. And before we get into the weeds, I want to explicitly remind you that we are here to do an impartial analysis of the data. This is a natural debate of the facts from the sources we've gathered, and it is absolutely not financial advice.
Never.
So to understand if this stock has true value, we have to look under the hood at the actual money, the cash coming in and the cash going out. We're looking at the fiscal year 2025 and Q1 2026 financials.
Yeah, and the top line numbers, the ones that get blasted out in press releases, they're designed to look spectacular.
Of course they are.
Right. I mean, revenue recently hit $33.82 million. And quarter 4 of 2025 was touted as this massive milestone because it was the company's first profitable quarter, posting an earnings per share of 53 cents.
Which is wild because when you look at the annual trajectory, it looks even better on a stock screener. Like, their full year earnings per share went from a devastating $16 loss in 2024 to losing just 50 cents in 2025.
A huge jump.
Yeah. So as a casual observer, you read that and think, the turnaround is finally here. The bleeding has stopped.
But the bleeding hasn't stopped at all. It has just been masked by top-line revenue growth.
Wait, really?
Yeah, because when you look past that $33 million in revenue and actually look at the operational efficiency, you hit a structural brick wall. The net margin for Datavault AI is a staggering negative 202%.
Wait, negative 200%?
Yeah.
So for every dollar they bring in the door, they're spending $3.
Exactly. They are losing $2 for every single dollar of revenue they generate. Yeah, and it's important to understand the mechanics of the sector they are in, right? Running AI models and these complex tokenization protocols requires massive, constant computational power.
Right, the server costs.
Exactly. Every time a client uses their platform or processes a transaction, Datavault is paying exorbitant server costs, cloud computing fees, and continuous research and development just to keep the models from degrading.
So they are effectively subsidizing their customers.
Pretty much. That $33 million in revenue likely cost them almost $100 million in raw operational expenses just to facilitate.
Jeez. So it's an illusion of a healthy business?
Yeah.
You have this massive top-line number, but the cost of delivering the product is fundamentally broken.
Completely broken.
And looking at the rest of their balance sheet, it almost feels like a trick. I mean, they have virtually no debt. The debt-to-equity ratio is 0.02.
Yeah.
And healthy short-term liquidity, their current ratio is 5.32. I look at this financial picture, and it feels like looking at a lottery winner who just cashed a massive check, paid off all their credit cards. But when you look in their wallet, they only have $20 left to their name.
That's a great way to put it.
Because despite the $33 million in revenue and zero debt, the most alarming data point in this entire deep dive is their cash reserve. They only have about $2 million left in the bank. How does that happen?
Well, with a negative 202% net margin, a $2 million cash reserve isn't a safety net. It is an hourglass running out of sand.
Right.
Because revenue is just the money coming through the front door. Net margin dictates how much of that money actually survives to make it into the corporate vault.
And for them, none of it does.
None of it. Administrative bloat, those massive cloud computing costs we talked about, executive compensation, these things devour capital daily.
Yeah.
So it doesn't matter if you have zero debt. If your daily operations are a furnace burning through your cash, $2 million will not keep the lights on for long.
And that $2 million cash cliff isn't a secret. The market can see it coming.
Oh, absolutely.
When you look at the stock's price action today, you can actually see that fear pricing itself in real time. Which brings us to the charts and the technical reality of DVLT.
Yeah, the charts are essentially the visual representation of market psychology. And right now, that psychology is screaming caution.
Even with the bounce today.
Yeah, even though the stock ticked up 1.26% today, the macro trend over the last year is undeniably bearish. I mean, we are looking at a descent from $4.10 down to 70 cents.
Right, though the technical indicators are throwing off a lot of noise right now. Like, let's look at the RSI, the Relative Strength Index.
Okay.
It's sitting right in the middle, hovering between 49.2 and 51.1. Usually a number around 50 is considered completely neutral, neither overbought nor oversold.
Sure.
And then you look at the MCD, which is giving mixed signals, but kind of hugging the zero line.
Yeah.
But the moving averages tell a much darker story.
They really do.
The price is currently trapped underneath declining 50-day and 200-day moving averages. The 50-day is sitting right at 70 cents, acting as an immediate ceiling, and the 200-day is way up at $1.23.
And we also need to map out the battleground for the order flow here.
Okay, let's do it.
So primary support, the floor where buyers have historically decided the stock is too cheap to ignore, is down at 66 to 68 cents. There is a deeper absolute trendline floor at 57 cents.
And resistance.
Resistance, the ceiling where sellers immediately overwhelm any rally, is sitting right above current levels at 73 to 74 cents.
See, I have to challenge this idea of the RSI being neutral just because the number says 50. I mean, let's use an analogy of a boulder rolling down a steep hill.
Okay, look at.
If we are trading below the 50-day and the 200-day averages and volume is going up while the price is going down, aren't we just watching gravity take over?
Yeah.
The boulder hits a small bump, bounces up for a second, and that bounce resets the RSI. But the hill is still sloping downward. Why would any trader look at an RSI of 50 here and think the stock is stabilized?
Well, a lot of novice traders make that exact mistake.
Really?
Oh, yeah. They look at a single momentum oscillator in a vacuum. You have to remember, the RSI only looks at the speed and magnitude of recent price changes, typically over just a 14-day window.
Ah, okay.
Because the stock popped nearly 25% over the last 2 weeks, the RSI reset from an oversold reading back to 50. It's essentially saying, in the last 14 days, buying and selling pressure equalized.
But it ignores the rest of the mountain.
Exactly. It is completely blind to the macro picture. It doesn't factor in the drop from $4.
So it's just a snapshot of a tiny window of time.
Yes. Furthermore, if you look at the MACD, the moving average convergence divergence, this is a tool that tracks the relationship between two moving averages to show us trend direction and momentum.
Right.
When it hugs the zero line like it is now, it means there is no clear bullish momentum pushing the stock higher. The energy from that 25% spike is already evaporating.
And the volume profile backs that up perfectly. There is a massive daily volume here, about 40.78 million shares trading hands daily. But in the most recent sessions, we are seeing volume rising while the price is falling.
And rising volume on falling prices is a classic textbook precursor to further downside.
Because people are panic selling.
Basically. It means that as the price gets cheaper, you aren't seeing buyers rush in for a bargain. Instead, sellers are becoming more desperate to get rid of their shares, and buyers are stepping out of the way. Supply is overwhelming demand.
So the charts look incredibly dangerous. Gravity's pulling this thing down. Naturally, you would think we should look to the smart money, like the institutions, the hedge funds, the insiders running the company, to see if they are throwing this stock a lifeline.
You would hope so.
Right. Like, are they defending that 66-cent support level? But when we look at the data, the absence of smart money is just deafening.
It really is. Because if a company is truly fundamentally undervalued, you expect the people with the deepest pockets and the most inside knowledge to be quietly accumulating shares.
Buying the dip.
Exactly. They build their positions when there's blood in the streets. But institutional ownership for DVLT is sitting at a microscopic 0.66%.
Less than 1%.
Yeah, that shows an absolute lack of conviction from major funds. But the most glaring, brutal piece of data in this entire analysis is the insider activity.
Oh man, this part is wild.
It is. In the last 90 days, the insiders at Datavault AI sold 24.6 million shares.
Wow.
Depending on the exact reporting window, they extracted anywhere between $13.5 million and $45.7 million in pure cash. Meanwhile, there have been absolutely zero insider buys.
Zero.
None. And selling 24.6 million shares is not a routine diversification strategy.
No, definitely not.
That isn't an executive selling a little stock to pay for a new house or, cover a massive tax bill. That is a systematic, aggressive exit by the exact people who look at the daily operating metrics and the cash burn rate.
What makes it so wild is how completely fractured the Wall Street analyst ratings are while this insider exodus is happening.
The disconnect is fascinating.
It is. The overall consensus rating across platforms is a hold. Wall Street Zen even recently upgraded the stock from a strong sell to a hold.
Right.
And Maxim Group maintains a buy rating. I mean, they did lower their price target from $4 to $3, but $3 is still a massive premium from where we are today at 70 cents.
Huge premium.
Meanwhile, WiSA Ratings maintains a firm sell.
Yeah, so you have a company with a $430 million market cap. Some analysts look at the buzzwords in the sector and determine that for a tech AI company, that valuation is incredibly cheap.
But the hypocrisy is staggering. I mean, if analysts at Maxim Group think this is a $3 stock, which would be a life-changing gain from 70 cents, why are the insiders rushing for the exits?
It's a great question.
It feels like, okay, if I go to a highly rated restaurant and I see the head chef sneaking out the back door to eat fast food in his car, I'm not ordering the tasting menu.
Right.
The chef is refusing to eat their own cooking.
I love that analogy. And, the disconnect comes down to how an analyst builds a theoretical model versus how an executive navigates reality.
Okay, break that down.
So an analyst at a firm like Maxim Group builds a model based on projected future revenues. They see that $33 million quarter, they see the press releases about future contracts, and they extrapolate those numbers 3-5 years into the future.
To assume everything goes perfectly.
Exactly. They look at the AI sector, assign a growth multiple, and spit out a $3 price target. It is theoretical math based on perfect execution.
But the insiders aren't living in a theoretical spreadsheet.
No, the insiders are staring at a $2 million cash balance. They're the ones actually signing the payroll checks and paying the server costs that result in that negative 250% net margin.
Right.
Analysts are grading the architectural blueprints of a beautiful mansion. Insiders are standing in the living room watching the foundation crack. They know exactly how difficult it will be to bridge the gap between today's cash crisis and those 5-year projections. So they are securing their own financial futures before the market forces the company's hand.
And this massive contradiction is the core of our deep dive. We have analysts projecting a $3 target and insiders dumping tens of millions of shares.
Yeah.
It sets up the ultimate debate. Is Datavault AI an undervalued gem waiting to explode? Or is it a textbook value trap designed to crush retail investors?
Yeah.
Let's unpack the bull case first, the scenario where this stock actually recovers.
Okay, the bull case. This requires you to believe in hypergrowth and flawless execution in incredibly trendy, high-margin market sectors.
Because management is very loudly projecting 400%
Yes.
growth.
They have reiterated a fiscal year 2026 revenue target of a staggering $200 million.
And they are pointing to some massive numbers to back up that claim. In Q1 of 2026 alone, they signed $750 million in tokenization contracts.
Now, we should clarify what that actually means. Tokenization is the process of converting the rights to an asset into a digital token on a blockchain.
Got it. And the company claims these contracts will generate $77 million in pure fees.
Right.
They're also aggressively expanding into Asian markets. Like, they secured a listing on the Biconomy exchange, specifically targeting meme coins and real-world assets, or RWA tokens.
Which is huge right now.
It is. RWA is essentially taking physical assets like real estate, art, commodities, and digitizing them so they can be traded globally. In the crypto and AI space right now, those are the magic buzzwords.
Absolutely.
So if they can successfully build the infrastructure for $750 million worth of assets and collect those $77 million in fees, 70 cents is an absolute steal.
Yeah, but the operative phrase there is if they can successfully build the infrastructure.
Right.
The bear case, the trap scenario is rooted in the harsh structural reality of how the stock market functions when a company runs out of fuel.
Which brings us back to the cash.
Exactly. First, you have to look at their historical performance. This stock has underperformed 81% of the entire market over the last year. It has a long habit of disappointing its investors.
But the ultimate risk, the thing that turns an underperforming stock into a lethal value trap, is that $2 million cash pile. Because $2 million won't last them the year. Probably not even the quarter with those negative margins.
No, it won't last the month if their burn rate accelerates.
Yeah, because those tokenization contracts sound amazing, but they take massive upfront development work before those fees are ever realized.
Precisely. To survive and to actually have the capital required to hire the developers and pay the server costs to execute those contracts, they need immediate cash.
And with institutional backing sitting at less than 1% and no desire or ability to take on crippling high-interest debt, there is only one place a publicly traded company goes for cash.
They go to the stock market.
They issue more shares.
Yes, which leads to massive share dilution.
I want to frame this from the perspective of a retail trader, because this is where so much money gets lost in the market.
There really is.
Imagine a retail trader sitting at home looking at a stock screener. They see DVLT. They see the 52-week high was $4.10. They see the current price is 70 cents.
They think it's on sale.
Exactly. They think, I'm getting an 80% discount. The RSI is at 50. The company just signed massive contracts. This is a steal.
Yeah.
So they buy the dip. But what are they actually buying into?
They're buying into a math problem where the denominator is about to explode.
Walk us through that.
When a company is out of cash, management will authorize the creation of brand new shares out of thin air. Let's say Datavault AI currently has 100 million shares outstanding.
Okay.
To raise the cash they need to survive, they might issue 50 million brand new shares and sell them into the open market.
So suddenly there are 150 million shares out there.
And that structurally destroys your equity. Your slice of the pie just got significantly smaller.
Right.
Even if the company eventually hits that $200 million revenue target, those profits are now spread across a much larger number of shares. The stock price doesn't magically go back to $4.10 because there is simply too much supply weighing the price down.
So it's an illusion of value. You think you were buying a $4 asset for 70 cents, but the company is printing so many new shares that the asset is fundamentally changing its shape while you hold it.
That structural destruction is why the downside risk is so severe here. Those $750 million in tokenization contracts mean absolutely nothing to you as a shareholder if the company goes bankrupt or dilutes your equity to near zero before those fees are ever collected.
So it's a trap.
The value trap is sprung when investors buy based on past peak prices without accounting for future share counts.
So as we pull all of this together, what does the timeline look like for DVLT? Like if you were actively watching this ticker, how do we summarize the outlook?
Well, in the short term, the technical data points to a weak negative outlook. The moving averages are acting as a ceiling, and that rising volume on falling prices suggests sellers are fully in control.
Right. The charts indicate a potential 8% fall in the coming weeks as the stock searches for a new bottom pivot. It has to find a floor, likely around that 66-cent support level, where buyers actually want to stand their ground.
And in the medium to long term, this is the definition of a high-risk, high-reward standoff. The entire future of this company depends on a flawless execution tightrope.
They have to hit that $200 million revenue target.
Yeah, and they have to magically manage their cash flow to avoid bankruptcy-level share dilution.
It's a race against the clock. Like, can the $77 million in fees from the new contract hit the bank account before the $2 million runs dry?
And given the negative 202% margins and the upfront costs of executing AI and RWA protocols, that is a Herculean task.
We have a company boasting a future with 400% growth, massive Asian market expansion, and hundreds of millions in new tokenization contracts.
Yeah.
Yet, the people who know the company best, the ones looking at the actual bank's accounts, are selling every share they can.
Yeah, they are.
So as you watch this play out on the charts, consider this. If those insiders just cashed out tens of millions of dollars to secure their own financial futures, what do they plan to do with that capital next? Are we watching the slow public death of one company or the quiet off-the-books funding of their next venture? Keep an eye on where those executives land next.